Ladies and gentlemen, welcome back to the bear versus bull debate on fintech stocks, mainly having to do with SoFi stock. And today we're talking about the bearish side. So I recently saw this article from Forbes that was covering more news on the Synapse failure. Okay. Now, if you guys haven't heard about the Synapse failure, they are a fintech that deals with the technology between fintechs and banks. And they recently just filed for bankruptcy, and a lot of customers' funds are still tied up in this mix. Now, let's go through because there's some explaining that they talk about in this article, so I don't want to take away from the video. Mercury, Yada, Robinhood, Cash App, Brex, Chime, Dave, and a host of additional firms all provide banking-like services, but none are actually chartered banks. These firms all require partner banks to provide access to banking systems. See, if you don't have a chartered bank, you can't take on customer deposits without having an actual bank to partner with. Okay? In some instances, it's difficult for customers to understand that they are not directly dealing with an FDIC-insured bank. Now, I took this image from Dave's website. They said, hey, rest assured, your money is completely safe. It's tied up with Evolve Bank and Trust. They're the member of the FDIC, so you are fine. Well, that might not actually be true. Proponents of the fintech industry call this arrangement banking as a service or rent-a-charter fintechs, okay? Fintech companies appear to customers because they provide a product that is not generally available directly from a chartered bank. Either they don't have services that, or either they do have services that banks don't offer, or the product quality is potentially a little bit faster through mobile, or potentially higher APYs, or something along these lines where a customer be getting a better experience from a fintech rather than, one of the big five banks or credit unions or something like this. Now, some chartered banks entered the banking as a service business because it seemed to attract methods of obtaining low-cost customer deposits. Partner banks typically provide fintech firms with a single account at the bank where all of their fintech funds were conglomerated. So let me give some insight onto these two, parts here before we move on. One, chartered banks have a lot to gain from these banking as a service partnerships. They get all the customer deposits, and then they potentially are dealing with the APYs of the customers. Potentially that is a split amongst the fintechs, and potentially there's some additional administrative fees that the banks will charge to the fintechs. Okay, so they have a massive, advantage here because all they're offering is the compliance and regulatory means of allowing customer deposits to come in. It's really the fintechs that once they actually have this conglomerated account, they are the ones that are controlling the ledger to make sure who has what within those accounts. Okay. The problem came whenever middleware companies start to get in the mix to connect the banks to the fintechs. So I put up a couple names here that are very, very big in the space. Synapse, obviously they're big in the news right now. Galileo Technologies of SoFi and Marqeta. Okay, so in April of 2024, the middleware provider Synapse filed for bankruptcy and materially impacted fintech firms and customers. Almost 6 months after that bankruptcy filing, there's still customers that do not have access to their money because Synapse was actually going to be controlling the ledgers and controlling all that information for the fintechs and banks. Whenever they went under, it actually allowed for the banks not to know what money is for which user. And the fintechs didn't have that information either, so they weren't able to pay that money back. Okay, so there's still people with missing, amounts within their accounts. See, if we go back up to this, thing for Dave, this FDIC insured up to $250,000, well, that's in case of a bank failure. That has nothing to do if the middleman or the banking as a service provider is actually the one failing. So now there's a rush right now to potentially change this. Let's see here. In a unanimous vote, in September of 2024, the board of the FDIC approved a proposed rulemaking on requirements for custodial deposit accounts with transactional features and prompt payments of deposit insurance to depositors, better known as the Synapse rule. Partner banks would be required to know the beneficial owners and balances in those, sort of conglomerate accounts. And hence, for the banks, the complexities are going to increase and the cost to partnering banks will also increase because there's going to be a lot more complexity here if they do need to know every single one of those customer names and be a part of the ledgers as well. So it's a lot added on, but yet it may potentially protect against this situation here because then the second Synapse fails, they will be able to potentially either still do withdrawals for customers or transfer that information to another fintech like Galileo or Marqeta to continue those transactions and get back into the flow of business. So banks are already withdrawing from relationships with fintech funds. Okay, you're seeing a host of names that are potentially stepping back from some of these, relationships because at the time, whenever there was no rules set on this, it was a profitable business. But the more complexity that they get into it, they may not want to build out, more infrastructure for something that was just a small part of their business. So they're just saying, hey, let's wash our hands clean of this. Let the fintechs find a different partnering bank to continue on with those relationships. Now, there are a number of fintech firms seeking partner banks, and such relationships are proving hard to find. What was interesting, whenever we go back up and look at these three names, one, Galileo is the only company amongst this list of really big BaaS providers that is actually profitable. And then next, they're the only one where the actual partnering company is truly like a member of the FDIC and a fully chartered bank, which would be SoFi Bank. So although this article so far is very scary for a lot of banking as a service providers, it may not be as bad for Galileo because they're in quite a different situation. Now, two members of the Senate Banking Committee, Senator Elizabeth Warren and Chris Van Hollen, have asked banking regulators to restrict the use of FDIC name and logo by non-bank entities and to begin supervision of fintech companies. Now, this has been in the talk or in the works since like 2012. But because of the failure through Synapse, this might actually get expedited because obviously customers not having their deposits for 6 months is just completely unacceptable. Now, this is what we can expect, and I agree with this. We're going to see joint ventures between banks and technology companies, and for the banks to take the lead in these ventures for management, compliance, and ensuring safety and soundness. The financial returns for fintech companies will change, and banks will need to receive a share of the upside to better reflect both the costs and the risks to the bank. The current companies that exist today may not exist in the same way tomorrow, but those same good qualities of good quality products, new services, and everything will be around continuously. So I thought that this was really great. I have this little added thing right here, this Coalition for Financial Ecosystem Standards that I want to talk about in a second, but it is very interesting. I completely agree with this. It seems like the only company who's already done this is SoFi. They're the only one that actually has the technology platform and a fully chartered bank, which completely takes them out of the mix whenever you're looking at all these different rule changes. Now, whether or not these companies will have to that are currently working with Galileo may need to change their relationship. It may be that potentially there's a different mix between the partnering banks that they work with, or potentially the fintechs that those like Dave, for example, works with Galileo. Potentially, they might need to stop working with Evolve Bank and Trust and potentially work closer with SoFi Bank because they would actually have that information that Galileo has on file because they're the subsidiary company, right? Let's go back really quickly and talk about this Coalition for Financial Ecosystem Standards. So an article came out recently on Yahoo Finance where this essential voluntary regulation framework is coming out from companies like Block, Brex, Mercury, Relay, Row, and Stripe, some of the biggest fintechs on the market, to team up, create this coalition to sort of set a framework for compliance to better understand what their customers have in their accounts, how to better treat them, better auditing and safety, all of these things. So key outcomes: clearer alignment on compliance and risk management practices, standardized expectations throughout initial due diligence and various phases of growth, and enhanced trust and compliance across the fintech ecosystem. CFES will serve as a vital bridge between innovative fintech companies, partner banks, and financial services regulators. And our goal is to build trust, enhance transparency, and drive efficiencies in bank, non-bank partnerships, ultimately contributing to a more dynamic and secure financial ecosystem. That's great, but that's not the law. That is a voluntary framework that they are doing themselves to try to get ahead of this, which, by the way, this came out on October 1st, right once like all these articles are starting to come out saying that there's going to be big changes for fintech. So a lot of them are trying to buckle down. Now, the reason why they're creating this coalition is that they want to lower their costs trying to learn all these new safety measures so they can work amongst each other to, help their margins stay high. But even with this coalition, it is still extra practices that they are going to have to get used to, which is going to be more costly, right? More audits, more time before producing new products, all of these things that might slow down the fintechs to a more bank-like speed, putting SoFi and Galileo, back into a more competitive mix whenever it comes to having to talk to regulators before producing new products. Anyway, ladies and gentlemen, let me know what you guys think in the comments down below. Is fintech as an industry going to be in a similar place as it was before the Synapse failure? Or do you think that potentially multiples might fall as it's going to be harder to potentially produce and make new products and have extra costs that they didn't have before? Thank you all so much for watching. Really do appreciate your time, but bye for now.